Welcome to this week's version of Nichols and Dimes, our weekly video series. Well, we are in the early part of 2022, and we've seen a ton of volatility, particularly in the equity markets, the last few months. So I wanted to share with you just some ideas on how to reduce risk and volatility that really was prompted by an article I'd read over last weekend that I thought I'd share with you. Why am I bringing this up? Because at the end of the day, if you are nearing retirement or in retirement, or if preservation of capital is one of your primary goals, you want to reduce volatility and risk, if you can, right? So we're going to just jump into some ways to do that today. So let's just jump in here. One of the things I wanted to share is some data that was shared with us from Vanguard. And they recently reported that around 17% of retail clients ages 65 through 74, presumably most of these folks are retired, have 98% of their money in equities. So think about that. 17% of retail clients ages 65 through 74 have about 98% of their money in equities. That is a lot, in my opinion. Furthermore, 40% of Fidelity's 401k investors aged 60 through 69 hold 67% or more of their portfolio in stocks. Look, as I mentioned earlier, one of the goals, at least the primary goal, as you're nearing or in retirement, is reducing your risk, mitigating risk, and having capital preservation as a goal. And you tend to see these types of statistics where an asset class tends to dominate if it's done well, right? I mean, things have done well, an asset class done well, people tend to pour money in it and think that move up, if you will never end. So again, I'm going to share with you a little bit about some ideas on how to hedge your portfolio that we think can give you some longer term, lower volatility and help reduce risk. But a little perspective, if you are a watcher of our videos, you've seen us share this chart before. This is a chart of the S&P 500 over the last 25 years. Again, that's that green and red sort of squiggly line. On the far left here, of course, you had the mid to late 90s, then the big downturn that was the dot-com bust. In the middle of the screen, the run-up to the financial crisis of 2007, 2008, and early 2009. And obviously, you had a big move. On the far right, you had the coronavirus drop February to March of 2020. And then obviously, we've had a big recovery. I'm bringing this up for perspective, just to give you an idea where we are in the market cycle. That white line is something called the moving average. Effectively, it's the closing price of the S&P over a 60-month period rolling. And then effectively, that's a white smooth out line. That's that moving average. Why is this important? Looking at the far right here, you could see, just for some perspective, in January of this year, the S&P was 48% above that moving average. I'll explain why that is important in a minute. Back in the financial crisis, at the peak around June of 2007, the S&P was around 30% above this moving average. And back in the dot-com years, at the peak of the dot-com situation, when things were great and every company was changing their name to dot-com, the market was around 64% of the moving average. I'm bringing this up today just to give you some perspective. Two things. Number one, when the markets are stretched and extended beyond a moving average, or I should say, when an asset class is stretched and extended, as it is now, as it was in the financial crisis, as it was in the dot-com bust, your risk of having a drawdown or a very severe correction or a bear market is higher, right? So anything that gets stretched and extended beyond, let's call that white line, the moving average, a norm, you tend to see some kind of reversal. If the past does not equal the future, there's a reasonable chance it will rhyme. And that's where we are. So all that to say is, look, where we are in this market cycle, the equity markets are stretched and extended, in our opinion, primarily generated by low interest rates and, money printing. The markets like the money printer. So we are very cautious right now, again, because of some of the data we're seeing, including, and again, we're oversimplifying it here, but just some perspective given the chart. So what can you do to reduce risk of your overall portfolio? One of the things that you could do is, of course, diversify. Most folks, at least if you're in a moderate allocation, you have something like a 60-40 portfolio. I mean, this is pretty standard. It's been around for years. Many folks that are probably watching this video have a traditional standard portfolio. One of the things you can do to consider is maybe reducing some of your bond exposure. We talked in some of the past videos about, particularly about how inflation, the Fed said it's around 6.8%, that's CPI. If you're earning 2 to 3%, and inflation, say 6 to 7 or even higher, your real rate of return is negative. So consider looking into alternative investments such as private equity, private credit. You can even look at real estate and hedge funds. These are some generic ideas to help reduce risk. And so that ultimately you're just reducing, for example, instead of having a traditional 60-40 portfolio, you have something like a 60-30-10, 60% stocks, 30% bonds, and maybe a small portion alternatives in the portfolio. Furthermore, and this kind of ties into where we are in the equity markets. In addition, that 60%, we're suggesting, particularly where we are again in the market cycle, since we're so far extended above that moving average, and if history does repeat itself, or if it even rhymes, we're suggesting for you to consider reducing let's call it risky part of the portfolio, and in particular, the unhedged or unprotected part of your equity portfolio. How do you do that? How do I hedge my stocks? How do I hedge my equities? Again, we've talked about this in the past. There's simple ways to do that. There's raising cash. Maybe you take profit on some of the positions that have run up, since the March 2020 lows, or maybe over the years. Maybe you just raise cash. Consider taxes, of course, in the equation. Another way to do it is maybe you don't want to, liquidate some of your positions because of the tax situations. You can, hedge it with options. Some people are not experts in that. So you need to deal with an advisor who has expertise in that space. The other thing is consider maybe you learn, or you have a strategy that is effectively shorting stocks. That's basically participating. If the markets drop or if the specific stock drops in value, your stock, if you short, or the value of your position will appreciate. So again, there's multiple ways to do this, but the message I want to communicate today is that we're suggesting, again, we're in a cycle of the equity market that we think is on the riskier side. So again, no one knows what the future holds, but given some of the data that we know and that we are interpreting, it looks like it's quite concerning. So again, here's some ideas that we'd like to share with you, just to again, how to potentially reduce risk and volatility in a portfolio that we think makes sense. So that end, if you would like a second opinion on your portfolio, again, just like an idea, if your portfolio is positioned, if we have another big downturn like we did in 2007, 8, and of course at the end of 1999, you can send me an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com to learn more about what we do. Thanks again for watching. Have a great day. Bye-bye.